I think right where we are in gold right now, where it's been consolidating. I think it's very close to popping. In fact, if we were to go right over to 2007, gold went sideways for many, many months. And then suddenly, just as the stock market was starting to roll over, gold shot higher and it rocketed up about 37%, something like that. And so this huge pattern is like exactly kind of where we're at right now when we look at gold. It's had this big run up. It's been trading sideways for months. And I think we have one more big push. And I think you're right, David. I think, it is a pause and consolidation at this point. You have to expect it to go higher. To me, I don't see anything bearish about this chart pattern. It really is pointing to higher pricing. It's kind of it in a nutshell. They just tweak the odd word here and there and throw in a new little phrase. I mean, I think people read into it way too much. They're always balancing on, they're always saying they're going to make adjustments if needed. Who cares how they say it? It's the same thing. I just don't read into those statements and all that stuff too deeply, because they're always weighing everything and they're going to make a change. That's why you really just need to follow price, follow the money flow, because you don't know what they're going to do, when they're going to do it. And it really is, their words are like a spell, and they suck people in, and they just kind of control, they have it nailed down. They know exactly how to say to not quite give enough, but there's no direction, and you're just always uncertain. So people need to not read into that too much and actually follow the price charts from multiple time frames, as you just said, and that'll keep you on the right side of the market. If we do take a look at that, this is the stage 3 chart that you're talking about, and I've talked about how I believe we're in this stage 3 topping phase for a long time. Now, there's this. The thing with this, where we are in the market environment, is we have Magnificent Seven doing a lot of the heavy lifting, pulling the NASDAQ and the S&P 500 to new all-time highs, not representing this kind of topping phase in most stocks. And if we go back and we look at this particular blend of ETFs, now this is the RSP, IWM, and IWC. This is the more or less broad market. It's equal weighted S&P 500. It's small caps and it's micro caps. If we just zoom out, I mean, the grand scheme of things, we'll just go way back here. The stock market isn't breaking new all-time highs. We potentially have a major double top or triple top, however you want to look at it. We haven't really fully broken out with all stocks to new highs. We're pretty darn close, but we're not there yet. And this is usually, every time we've seen the stock market, the overall stock market get to this level, we have seen a 20+% crash and correction. So we need to be very aware that we're at this tipping point where the market could roll over. I shared that chart of 2024, how it shows this is kind of right when it went into a nosedive last year and sold off.
Market cycles are well defined: growth, acceleration, topping, and decline. Many analysts believe we are now in stage 3, a topping phase. While the Magnificent Seven tech giants push the NASDAQ and S&P 500 to record highs, the broader market tells a different story. Equal-weighted indices, small caps, and micro caps remain far from historic breakouts. This divergence suggests fragility beneath the surface. Similar setups in the past have preceded sharp corrections of 20% or more. As indexes flirt with double or even triple tops, the market appears to be standing on a fragile ledge, ready for a potential downturn.
If we take a look at the seasonality chart of the S&P 500, usually right at the end of August, the market starts to sell off into October. So there's a lot of headwinds about to run into this market. And while the trend is still up, you need to know it might come to an end soon. If you're in positions, you might have to exit them soon, take a potential loss, or start locking in gains. But overall, the broad market to me is in a stage 3 topping phase. To me, this is that stage 3 massive topping phase where we could go into a bigger sell-off and go into a stage 4, a financial reset that could be a 50+% crash in some of these indices, which kind of leads over to another chart. I'm not sure you and I have ever really shared before. If we come down here to the economic and business cycle. Now, I usually show the stock market cycles, but this one focuses on this yellow cycle, which is the business, the economic cycle. And what's interesting, the cycle in the background, the blue one, is the stock market. We're right here near this major top in the stock market. This is where innovation and adaptiveness adaptation, eagerness really comes into play. And because the innovation right now, it happens to be in tech, in large tech that drag the indices up, it's camouflaged this stage three topping phase. So yes, the indices are going up, but it is still really a handful of stocks doing most of it. And that's because we have AI. That's because everybody's adapting and bringing it in, and it's spurring all kinds of work and innovation and costs and sales. And it's keeping I think the economy really purring here and holding its ground.
History shows August through October is often a volatile stretch for equities. Seasonality charts reveal consistent late summer weakness, with September standing out as the market's most bearish month. In 2024, stocks peaked around this very period before tumbling. Today, conditions echo that same precarious setup. Rising interest rates, slowing earnings, and geopolitical uncertainty add to the weight pressing down on equities. Investors who ignore seasonality may be blindsided by the same cycles repeating. When markets approach historic resistance during one of the most dangerous windows of the year, risk management, not optimism, becomes the smarter strategy.
But once this phase fizzles out and people realize, okay, well, yeah, AI is great, but it still has a lot to come, to unfold before it really becomes really useful, then I think the markets will roll over. So we're in this phase where people feel the innovation and they're applying it. And it's just another one of those signals that we're got to be aware that, usually when the music's good and everybody's having a good time and you're at the top, there's usually only one place to go, which is down from there. And so we're in this, I believe we're slowly maturing through this stage three topping phase, through this economic cycle. And we're already seeing it with ChatGPT. I mean, Sam Altman, really threw a curveball with anybody using ChatGPT. He forced ChatGPT 5 on everybody. It's not the best. It has all kinds of issues. Everybody complained right away. And within a day, they brought ChatGPT 4.0 back. They're cutting costs, supposedly that new system. Long story short, AI is realizing they need to stop bleeding money and they need to start focusing on efficiency and slow down a bit. So that's where I believe we are in this kind of economic and this business cycle. And once it does start to slow down, we might actually see the economy slow down and jobless claims start to go up.
The rise of artificial intelligence and big tech innovation has temporarily disguised deeper market weakness. AI has fueled corporate investment, consumer hype, and earnings growth, keeping the economy buoyant. But innovation-driven rallies often mask fragility beneath the surface. Once the hype cools, the reality of high costs, slow adoption, and limited near-term returns begins to sink in. This cycle resembles past periods when breakthroughs sparked short-lived euphoria before fading. If AI optimism fades, the broader market could lose its strongest support. A topping market disguised as innovation-led strength is still a topping market. Camouflage only works for so long.
You know what? I guess I'm guilty for it. In fact, I've written a few very interesting articles here. And this one over here, I think people need to read. If you think I'm a perma bear and I drive you nuts with my bearish topping claims, yet I'm always long the markets, which I know gets under people's skin, they need to obviously follow me to get the full gist of it. But I wrote this article about me walking in as a perma bear into a bull market and how I'm guilty for it. But what it really means is it's actually one of the best compliments I could get, but people just see it the wrong way and they don't understand how I go about managing that. And all these articles here are very, very educational, and they help you see how the markets function, and they carry over into position management, risk management. And being a bear, people who are a perma bull, you've got, like, I just wrote an article about Cathie Woods to Tom Lee. Cathie Woods was the hero. She was the perma bull, had everybody into the markets until that strategy didn't work. And there was no exit plan. Everybody holding the ARK ETFs lost 75+%. Tom Lee is the new superhero. He's everywhere. He's super bullish, always has good upper forecasts. And this article talks about how that journey starts and ends with all of these different people that come through as mainstream media. And so anyways, if people want to hear about my perma my perma bear view. And what it actually means, it means I'm always looking out for our portfolio. I'm always focused on protection versus being totally blind to protection and just saying, oh, it's going higher, buy, 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 which is what everyone else does until the music stops. And then their strategy, most people realize it wasn't a strategy. It was them getting sucked into the markets, getting money under management. That's what these big institutions on Wall Street do, and moving people into their products. But yeah, so anyways, that's kind of my take on that.
Gold remains one of the clearest warning signals. Despite periods of consolidation, it holds near record highs, signaling global unease. Its chart pattern suggests another major rally could push prices above $4,000 per ounce. Silver, smaller and more volatile, may outperform in the short term. Analysts suggest it could surge toward $50 if momentum ignites. Yet both metals historically face liquidation pressure during sharp equity sell-offs, as seen in 2008. First they spike, then they fall with the broader panic. For now, gold and silver act as both a hedge and a barometer, flashing caution for the financial system.
I really like gold. I mean, gold has done many of these where, it has this big rally up and then it consolidates for months and then has a rally, consolidates for months, has a rally. Gold has been warning us for a long time. It's a top performing asset long term. It's near all-time highs. It has a very strong bull chart, a bull flag pattern that points to about $4,100 if this move plays out, maybe even a whole lot higher. But gold is warning us that something is wrong. The fact that it's holding its value and going up long term here is the sign that people around the world are nervous. And I think, gold, sometimes the market, there's a couple sayings. Sometimes the market will, if it can't shake you out, it will wait you out. And that is what it's doing. People are starting, I'm hearing some technical analysts getting really bearish on gold, saying that gold's about to fall, it's going to have a big drop, which I do think will happen, but not until the economy and everything turn over and we potentially go into a stock market, a bear market. I think that'll pull gold down. But it's funny.
A bear market will pull gold down.
A bear market in stocks will pull gold down eventually, just because of the selling pressure, the mass liquidation. And we saw this in 2008 once the stock market starts to pick up a lot of speed and sells off with huge volume and panic, gold usually gets sold off with it. But before that happens, gold usually shoots up. It'll go higher for a little while, for potentially a month or two, as the stock market starts to sell off. So I'm not really worried about gold. Right now, though, there's no doubt it's gone sideways so long, people are giving up on it. They're starting to go bearish. They're moving into gold miners because they're like, I need to get into something that's moving. This is right. Gold is boring. And silver is starting to move and break out, right? And so people are moving away from gold. That's usually a sign that gold's about ready to actually make a move. So I like gold and silver. And I do think they have potential for 1 to 2 months upward movement. And I think it could be, 20+% for both of them, which would put silver up near $50 an ounce.
Wait, sorry. When's that going to happen? This year? Next year?
I would think it's going to happen this year. I mean, I don't know for sure, but the chart pattern is based on, it should start to happen pretty much any week here. It should start to break out and start to run.
Being labeled bearish isn't necessarily pessimism, it's protection. Many investors follow bullish voices until reality proves otherwise, as seen with ARK ETFs, where hype turned to 75% losses. The lesson: markets rise until they don't, and most traders lack an exit plan. A disciplined investor respects both risk and opportunity. Gold, silver, and defensive positioning can act as lifelines when the cycle shifts. The goal isn't to predict the exact top, but to recognize the signs of transition. When euphoria dominates headlines, it often marks the final stage before reversal. Preparation, not blind optimism, determines survival in markets.
I think right where we are in gold right now, where it's been consolidating, I think it's very close to popping. In fact, if we were to go right over to 2007, gold went sideways for many, many months. And then suddenly, just as the stock market was starting to roll over, gold shot higher and it rocketed up about 37%, something like that. And so this huge pattern is like exactly kind of where we're at right now when we look at gold. It's had this big run up. It's been trading sideways for months. And I think we have one more big push, and I think you're right, David. I think it is a pause and consolidation at this point. You have to expect it to go higher. To me, I don't see anything bearish about this chart pattern. It really is pointing to higher pricing. It's kind of it in a nutshell.
Okay. Silver, you like silver more or less than gold right now?
Silver's got it has potential to have a decent move. I mean, it could actually pop and rally to, if we were to go all the way back, I think it could go spike up to that $50 mark. I think we could potentially see it pick up speed in the next month or two and shoot up and try and hit all-time highs. I think gold will rally at the same time. Miners, silver is really difficult. You just never know when it's going to have one of these explosive parabolic moves and shoot up. It has a lot of energy built up. It's a small market. A lot of people are watching it, accumulating it. And when it starts to run, it becomes a very crowded trade very quickly, which is what drives it up. At this point, I mean, I see it going to about $41 an ounce, but depending on how this unfolds, I think we could see a much bigger explosion to the upside. And it might have a blow off phase where we go right back into this 50 mark. And this will probably be exactly what you said, David. When gold and silver have that spike up, that's usually also when they come straight back down. So I think this will be that blow off spike move that puts a top in gold and silver temporarily, and then we potentially start to see it sell off.